Hi everybody, it's great to be here. I'm Per, I'm one of the founders of GP Bullhound. We help European entrepreneurs in their exit process and also as they grow, advising them on raising capital from overseas often. And we've been supporting White Bull since actually Farley laid down the plan of White Bull, and I really truly think this is one of the best events in the European calendar. So it's a real pleasure to be here. And just before I walked up here, I had a little chat outside on this beautiful patio, and the person I spoke to said, well, you know, as long as there is no buzzwords or acronyms, and I'm going to try to avoid that and give you straight data and straight thoughts from the trenches. In fact, I think my time slot is pretty long, so we'll have a chance to go through this in some detail and also open up for some questions. And given that the room is not that large and pretty dynamic group, I hope, feel free also as we go through the data to just hold up your hand or shout out if you have a question, because when we're at the very back end of it, you know, we may not forget it or I may not find that slide again. That's where I'm at. Okay. So this is how cool we are. Let's skip over that. So I think Farley is right. I mean, there's a sense of activity out there, and bankers and lawyers and entrepreneurs and VCs and private equity funds all talk about how busy they are. But the reality is actually not that. The reality is that M&A in the tech sector is unusually slow. And I can say for sure that what we're noticing is there's a lot of monitoring from the corporates, a lot of meeting and greeting, a lot of early due diligence, but actually ultimately pulling the trigger. I think the market is still suffering from a great degree of cautiousness. And it's if you remember this saying from the 90s, you can't be fired from buying IBM. I still think we're very much in that type of environment, that unless it absolutely delivers on users, on revenue, and is profitable, you know, you go really far, but you may not go all the way over the goal line. And and that in itself is, of course, quite funny because, I mean, it's a bit warm in here. I have to take this off. If I call up a potential biz dev department or a CEO and I tell them, listen, I got this really great profitable business growing 25% a year, they're like, that's too slow. And then I call with another company and say, this company is growing 100% a year and they're really reinvesting all their cash in growth. And like, no, we can only buy profitable businesses. And I mean, that makes it pretty tough to be an entrepreneur. And now I'm going to have to do a lot of head turning here today, I see. Let's see if this works. So you can see the... That would be good for me. Now I can walk around. So the blue bar, I think, in many ways is really the key bar when you're an entrepreneur. It's not so much about the value of deals, because one mega telco deal can just skew the numbers. It's the volume of deals, I think, is a much better estimate of the market appetite. And as you can see, it's not bad, it's not great. I think we feel that it's kind of a 6 on a scale from 1 to 10. And this is now the corporate buyer market. I'll talk about the funding market later on, which is quite different, actually. But what is positive is that, and you look over here and you can see my team really loves numbers. That also means it's kind of impossible to get anything. That way we look smart and you have to call us. But TMT as a percentage of M&A have grown from 12% to 19%. I mean, this is an absolute key number to take away. The proportion is starting to get so significant that it's a relevant discussion in any situation. And I think we will just know this intuitively. I mean, as consumers in our private lives, as consumers in the enterprise, we are today using all forms of technology basically all the time. I mean, you can almost say that we have augmented our species with technology now. I mean, imagine actually leaving home without a smartphone. I think that's a very scary proposition, not only for tech geeks, but from grandmothers and kids and so forth. And so that makes it interesting. And I think the takeaway that we find is when we struggle with the traditional tech buyers having appetite for particular businesses, we regularly find interest from completely non-technology companies, in our view, in wanting to engage and acquire businesses in the technology space. But many a time with also a slightly different view of how you handle M&A, being more discreet, not wanting to do a press release afterwards, not wanting to put it up on the databases and so forth. So I would say, just looking at what goes through our books this year, a good 25% of the transactions are unannounced and not in the stats. And that's much higher than any year previously in my career. But again, you look at the aggregate M&A value trend. So I kind of disparaged that a little bit earlier, but we still do need to look at that. And obviously, we come off the very heady days of 2007. It all dropped in 8 and 9, gradually picked up. But if you kind of double this up for 2013, we look like we're going to end up at a lower number. That said, my sense from what's going on is that Q4 is going to be a pretty good quarter. So I think we're going to end up with a flattish year. But what has happened is that US tech buyers, the traditional tech buyers, have been pretty active, but they've been active at home. So it's kind of good news for us. I mean, it's good news if you're willing to move your offices to US and become more of an American business. And I'm going to come back to the European story later, but no matter how much we bang the drum, and I really spend a lot of time at other type of conferences, because I don't need to bang the drum for you guys are the drum, that Europe is great and we're building great technology companies like Avito and Spotify and Klarna and Wonga and all these businesses. But the reality is, if we really talk about significantly sized exits, they're very US driven. That said, I'm of course very keen to understand why my team thinks Nokia was a US transaction. We clearly need better a geography lesson app for junior bankers. The other key takeaway here, and that we really do notice in pretty much every transaction that is consumer internet related, that is the re-emergence of Yahoo as a meaningful buyer. And it's primarily driven out of the Yahoo New York office. So if you go stateside, really do try to stop in New York on the way. I would say that meeting is always worth the effort. And with all that's going on in New York today in the media space, it's worth stopping there, not just thinking about Silicon Valley. That's a very clear trend shift we see. And I mean, don't get this wrong, but what's really nice with Yahoo as a buyer is they're a stupid buyer. I mean, they're in a desperate position. They're overpaying for really crap businesses. And that's a great starting point in a negotiation, because you can say, well, compared to that acquisition you did, clearly wasn't that good. I'm offering you something better here, and you can pay more than others. But also what we're seeing here is, look at Dassault, for instance. I mean, it's kind of the traditional parts of tech. And I come from a CAD background, started my career at Autodesk. So I get very excited when I see that. And again, I think if we look at the media, and Ben from Wall Street Journal sits here, there's so much focus on the consumer. But there's a lot of great businesses being built in enterprise software that shouldn't be overlooked for you who are investors in the room. And we're ultimately, unless you're in ad tech, you don't necessarily have to compete with Google, which is, I think, a best avoided strategy. We feel that Intel could probably do a lot more. Qualcomm, I mean, there's definitely companies that are more in the semi-systems layer. Even more blatantly, I would say TI, Broadcom, Marvell really do need to step up to the plate and start looking at some of the great technology that's being built in Europe, in the Nordics, globally on systems level. And everybody disparaged the Facebook IPO, but now they're back over the IPO valuation, so maybe not that bad after all. And I think we're going to see a lot more acquisitions from the Facebook team in the next 2 to 3 years. But then if we look at Europe, actually a decent amount of larger sized tech deals. So I'm very pleased to see that. And I'm not going to run through the list, but a few here I think are notable. I mean, for instance, the Kinnevik Group making a very, very big play on internet and e-com in particular. I mean, this is a large conglomerate that used to be in the forestry industry, and they betted everything on TV and telco, and they succeeded. There's now been a generation change, and they're putting all on black again, and you know, betting big on the e-com space. And I think for anybody who builds a business, it's really good when you have large corporates or large conglomerates that take these massive bets, and you can play into that trend. Whether they always pan out successfully or not is to be seen. But I personally have a lot of respect for large corporates that, you know, behave with that level of entrepreneurial risk. But I think what you do see here while I've been talking about other things is that the M&A activity in Europe is sadly not led by the media and technology companies in Europe. So I think we still continue to struggle from this huge challenge that in Europe, the large corporates believe that they can do all the innovation internally. And not to mention names, but there is a large telecom equipment business in Kista, originated in Kista, that's been selling base stations for several decades now. And every time you go in a process with them, and I've been in a process with them this year, it just dies. I mean, it's like they don't know what happens, and suddenly the champions are no longer champions, and they come back and say, we really wanted to do that deal, but we didn't know who should take charge. And I mean, that's a pretty big challenge to have if you want to be competitive. I really wish both the Chinese and the Finns good luck in trying to destroy that crap business. But also, the media companies, the media conglomerates, all talk a big game about going into internet and digital. But in fact, the only real big media company that has been built in Europe in the last 4 years is Rovio. And so that's kind of crap also. I mean, couldn't they have figured out a bird throwing game with all those budgets? And even in some businesses, and you take the Bonnier Group, for instance, who very successfully spawned Toca Boca, the children games company, that I truly think is a unique business on so many levels. They actually kind of hate that business. So when you go meet them, they're like, oh, yeah, Björn is kind of a weird guy, and he lives in San Francisco, and what happens over there, we don't know. And so a lot of work needs to be done here, and I think it needs to be done by us. I mean, we can't just run around and complain. What we need to do is we need to go to all these guys, whether it's the ProSiebens or what have you of the world, and just tell them that this stuff is real. It's not back pages internet anymore. Again, though, just to drive this hard nail home, the portion of M&A in Europe that's been driven by US buyers is low. It's too low. We need to get the Americans over here. And the interesting thing here is that our friends who work in the investment community in the US seem, in my opinion, to be a step ahead of the guys that work in the corporate M&A departments. So we've actually seen an absolute flood of US mid to late stage investors coming to Europe, doing very aggressive, smart transactions, getting in, running shorter processes, investing into some of our crown jewels ahead of the local European venture and growth equity community. And I think the story that we hear from these guys is that they feel that their own home market is significantly overvalued, and they find in general better value in Europe, and particularly better value in the Nordics and Eastern Europe. And I think those are very true messages and great takeaways for us as a continent. And we expect that will continue, and what we're also picking up, which is not yet in the stats, partly because they like to not announce so much, and partly because it's in the doing, is we're also seeing the hedge fund groups in US, particularly the New York hedge fund groups and Boston hedge fund groups, really coming to Europe, trying to do late stage category leader deals. And of course, they run a due diligence light model big time. I mean, it's a deal process that takes 4 days instead of 12 weeks. And I think that's very exciting. And again, a new form of capital and creating an ability for some share owners or entrepreneurs to do their own exit while the business lives on. And ultimately, I think for the whole community, be very good if we didn't always just ending up exiting these great businesses. So it's a slow IPO year, both in Europe and US. And if you meet people from NASDAQ or from London Stock Exchange, they're actually quite desperate. I mean, I'm not just talking desperate about missing out all these great technology stories. I'm talking about desperate about kind of not getting anything to come to stock market in general. So the fact that they're desperate means that they're willing to put in a lot of time for your businesses in putting you on that path. They're willing to take you on roadshows to meet public technology investors. They're willing to help you educate their buy-side community. And I think not for everybody, but for some companies, that's definitely something well worth doing because it's a very different pool of capital than the venture growth pool of capital. It's maybe not as smart capital in the sense that they will not have as many opinions in the boardroom. And for some entrepreneurs, that's not a negative, but a positive. We think that the Twitter IPO is going to be important. We hope it's going to be well executed, but it is a very risky one because similarly to Facebook and LinkedIn, I mean, kind of one underpriced, one overpriced. It is very, very hard for the stock market to price these businesses since you can't really run sensible multiples on them. And since the public markets buyer community don't intrinsically know the space as you and we do. So it's a bit of a gut feeling bet on whether you want to be long in a stock like this or not. And that creates a lot of volatility. Volatility that might be interesting for us to PA trade around, but it's not necessarily good for the PR around the industry in its own right. But I think here in Europe, it would be really interesting to see, for instance, if the Zalando group went public. I don't think they will, but I think that would be good. I think it would be awesome if Spotify went public or Avito went public or several others. But again, that seems to be more 2-3 years out than 2014. And perhaps the only exception is Ricardo with King. And we'll just have to see how that plays out. So lowest ever really percentage of tech as a portion of IPOs on the US stock market. So that's also quite disappointing because I think we all know that there is a whole bunch of great businesses out there. And I don't know whether this just means that the great companies of today, I mean, the Supercells, the Rovios, the Minecrafts, just don't feel the need. And it's so what? There can be a stock market out there, but we find liquidity in so many other ways. So we don't really care about the liquidity because our companies are so cash generative that as founders, we already have the G5s to fly around in. And you know, and that's interesting in its own right, and actually maybe more of a good than a bad. I mean, I'd rather be a share owner in IKEA than a share owner in Oracle. And what that has led to is these super rounds where really late stage investors, and as I alluded to, increasingly now proper public investors are changing their own rules to be able to go into businesses that ought to be public by size and success, but just choose not to be. And interestingly, we're seeing that here in Europe as well. And I can't speak so much about Skyscanner and Power, but I'm the advisor to Avito. And I mean, apart from raising now over $160 million of primary capital for this business, the really coolest deal in Avito actually took place just a few months ago, which is when Luxor, the US hedge fund, effectively bought out a founder stake in a public Swedish company called Vostok Nafta. And the interesting thing with Vostok Nafta was Vostok Nafta only held two assets, Avito and Tinkoff Credit Systems, which is the fourth largest credit card company in Russia that is on an IPO track. So Tinkoff was almost perfectly priced already in the market. And the delta was what you were willing to pay for Avito. And just to see that a new form of intelligent capital is willing to do that kind of complex deal making to get into, our industry's household names is really cool. And before that transaction took place, the internal view and also kind of people who had the chance to maybe buy in was that the value of the business was around $1 billion. Then Luxor reset that to about $1.5 billion. And now the research coming out only 12 weeks later the company Goldman values Avito at 2.6, Deutsche at 2.2. So in effect, not that much has happened in the business, but it's just changed what type of capital and what type of community that is looking at the company and what their alternative investment opportunities are. And I think the reality that we see is that if you today are a late stage or growth stage venture investor, you actually have plenty of opportunity to choose from. I mean, there's so many great businesses out there in all of Greater Europe, which means your capital cost is in effect high. But for the people who come more from the public market, the fact is it's very hard for them to get access to anything interesting. And they're obviously willing to pay much more of a premium to get into these stories. And that's a change of the dynamic that we haven't really seen since 98. And then another big trend this year that I also think is really positive for the entrepreneurs in the room. And let me just check. I mean, those who run a business rather than make investments, hold up a hand. Okay, it's a high quality group of people. I like this. Excellent. So what we're noticing, and these are concrete, completed transactions, but obviously there are transactions we don't advise on, a few, and there are transactions that are not yet completed, is that if you do want to take some chips off the table, both as a founder, as an early stage investor, as a mid stage investor, there is just plenty of opportunity for that today. And we find that there are many more buckets of capital that show an interest. I think again, media attention has become a great friend for us. I mean, the industry we're in is very visible again. It catches people's imagination. We're seeing a lot more interest from family offices. We even see interest from Swiss family offices. And that's pretty cool. That's like dinosaurs are waking up. But they always kind of ask, how do I hedge the currency? And I'm like, listen, this stock is going to either tenfold or you're going to lose all the money. Are you really going to care about that? And they're like, yeah, but we also hold gold. Okay, cool. But as I said, we see public funds. On one of these transactions, I can't mention which one, we had two of the large public fidelity funds that went long in one of these companies, which is really cool. These are huge funds, and they operate on a very different basis. And the way they look at it is they're starting to build a position. And of course, as an entrepreneur, that can be pretty attractive, because over time, as you build your gigantic rocket ship, you need to cycle out the capital so that everybody can go back and report to their LPs every 7 years how smart they are and get more money. And we all benefit from that. So I think that's really, really interesting. And we're going to see a lot more of that. We as a team get calls every day from large funds that say, can I get into that company? Can I get into this company? And sometimes, actually, they dig up companies that we as a community don't track. It's very clear to me that, at least I think, maybe big-headedly so, that we have a good handle of, the great European successes. But there are so many other great European successes with entrepreneurs that have never gone to a conference, but I've never called the VC. They just have chosen to kind of operate on a different path, and I think it's very interesting to try to see how we can get those businesses into the flow as well. So all in, I would say we see the community work very hard on creating exits. We see the corporate still not really delivering other than in very unique situations. We see the corporate still largely meaning US buyers, and we see them largely wanting to buy teams run by ex-employees working 2 blocks down 101 rather than in Europe. On the other hand, we see US capital very passionately feeling that their own market is overvalued and even erratic in where it puts its money, coming here seeking more stable, more cash generative businesses. And we see thirdly and finally a totally new pool of capital entering the market, ranging from the dinosauric Swiss funds to the 28-year-old hedge fund guys. So as activity has slowed, buyers have focused on larger targets. And this is, again, it's just a reinforcement of this sense of safety that I'm speaking of. It really has to be a category leader. I think the reality is only partly that, and I do think, let's see if there's a slide here. So, yeah, we're saying that that's what's in the news. But what's interesting here is 18% of the deals only are of above $100 million. So, I mean, at the end of the day, yes, sure. But there is a lot of activity going on in the bottom layers here as well. And this is globally or Europe? Let me check the footnote. This is global. But I would say we've run stats now. I don't think I have a chart on that, but we run stats for European tech M&A as we describe it: software, internet, digital media, semi-systems, but not biotech, not health tech, and not clean tech. And in our stats from 97, I think it is, we count from the median exit value in Europe is 32 million euros. And I think that's a good thing to think about. I mean, obviously, when you go up to work, you're not kind of getting excited about, yeah, I'm really going to go to work today and create a medium outcome. That's really hard to do. That doesn't feel right. But it's likely that you may end up in a medium outcome. So when you think about your own mortgage, and even more so when you think about the financing rounds that you do prior to getting to your hopefully not so median outcome, is I would strongly recommend you to not raise more capital than you really need. Operational cash is always cheaper than any other cash. Debt is always cheaper than equity, even though every owner you have tried to convince you that's not true. It is true. For sure, it is true. And then equity is damn expensive, and equity that comes with structure, whether it's preference structure, participating preference structure, fuck you up the ass preference structure, it's even more expensive, to the point, if it's at the point of some people's view of expensive, you might as well just give the business away and go and work at Ericsson in Kista. Because you're good at destroying stuff. So really be cautious with the capital that goes in, thinking about how your personal stake and what it will be worth in a waterfall at the 32 million euro exit. And then you go home and you tell your wife and husband and family that that's what's going to happen here in the next 4 years. When you go to work, you tell a bigger story, you'll end up somewhere in the happy middle. Valuations differ quite a bit between sectors. This is because as human beings, we have a very, very limited capacity to take in large quantities of data. So we create monikers. The best one, because it's by far the most stupid one I've ever heard. It's so unbelievably stupid, I lose my words. It's big data. I mean, who here thinks they run a big data business? Hold up your hand. Yeah, great. Medium data. And cloud. Come on, cloud. They're up here. They're full of water, not freaking data. I mean, we've had servers since the 60s. We put data in servers. The servers sit somewhere. They never sit in the cloud, ever. They sit on the ground. But if you put big data and cloud and SaaS, which means you rent your software in front of your business plan, you will get a higher valuation. This is also true. So we do it all the time, every day. We're like, how many monikers can we come up? Yeah. Clearly big data. So in the cloud. It's like, yeah, I got my server rack back here, but it's kind of a cloud rack. And as you can see, that works. And SaaS has really kind of broken up out here. And if you run a DCF model, you realize that the difference between a perpetual license with a maintenance income stream and rental software means it takes longer before you get the money. Everything else should be equal. The consequence of that is you need to raise more money to get to the same position, which means you will own less of your business when you're at that position. Now, I can be as angry as I want about that because clearly this is how people want to buy software today. So you got to sell it like that. But don't kid yourself that makes your business better. The software makes your business good or bad, no matter how you deliver it economically. The other really interesting one is e-commerce. So this e-commerce, for you who don't know what that is, that means you take a normal good and you sell it in a store that is not physical but online. The difference is you have a lot higher logistics cost and you have a lot higher marketing cost, but you save money on not having to rent a store. Our view is that it seems to be kind of a zero sum. But thankfully, we're kind of the only guys who think that. The rest of the world think that e-com is something really, really valuable, 3-4 times revenues, whereas companies like H&M, IKEA, etc. are 6-7 times EBIT. So I say, go start an e-com business and sell quickly. And if we now look at specific deals, and this is the worst thing in the world as a banker, is these kind of deals. Buddy, cloud. See? They even put it in their name. And they're top of the chart. Fantastic. Can you imagine what Mint would have got for multiple if it was like mintsascloud.com? Hybris, I like that. Success, I mean, this kind of plays on you, and you're sitting there like, come on, you can't just pay 2 times revenue for success factors. And people get really excited. And it's true. But the problem is, of course, then you go, the board decides, well, okay, we're going to sell this average business that we own that has a median value of 32 million euros. We're going to call Per Roman or Manish Madhvani, and they're going to come in and tell us what a great business we have. And of course, we're keen to win the mandate. Otherwise, we cannot pay the bills. So we come in and we show this slide. And we're like, look, market out there is amazing. Of course, the reality is these are 10 deals out of 1,000. So it is possible to get very high valuations. It's because these businesses were not bought on what the P&L is doing, but what the team has built. And I think for some of you, maybe all of you, you have built something that is so unique, you can just put the P&L in the drawer. But trust me, you're going to notice that after 5 minutes in an M&A process if your technology is that unique. And if it's not, it ends up as in 95% of M&A an earnings discussion. What are your cash flows? How much am I going to pay for your cash flows? So, what do we see here? Well, the Trados Naspers deal is good because actually I think what we've learned is the C2C or classified, also I would say dating I would put in that category. I mean, these are just amazing business model machines. I mean, you put up a platform where the user for free populates it with content that the user then takes care of the whole work of transacting and you charge a fee for that. So I think rightfully, companies like Rightmove and Avito and Naspers, and thereby the great long in Europe of this decade, Schibsted, are good bets. But there's a big difference between that and shipping books, or even, let's say, stuff like furniture or white goods to people. So I think our view here is that if what you got to do in this range of valuations is really try to analyze what is the business model. I mean, how profitable can this be? I mean, is it the same to buy something small like an in-app purchase in Rovio game every day? Is that the same as how often I buy a whole fridge and get it moved home? And which is the most expensive to ship to somebody's home? A bird and bull, or a fridge? Now, I think Facebook is a good example of how the buyer thinks about buying, and I don't think we spend enough time thinking about the other side of the table. I think this is true in all M&A. I mean, we think a lot about ourselves. I mean, how great is our business? What is our key selling points? You know, should we sell now or deliver this quarter and sell on 2014 numbers? But I think my experience is actually when M&A takes place, it's 90% because the buyer has decided that they need to do something, and you just happen to stand there in their way, being the solution to their board discussion. And so I call on myself and I call on all of you to spend more time, all the time when you build your business, to think about the agenda of the other side. And I think the really skillful entrepreneur, he befriends the other side early on, and he does business with the other side early on. He networks the other side. And today networking is very easy because we can all just use LinkedIn, and then we can go in and look at who looked at our profile, and we know exactly who wants to buy our business and do that. It's pretty astounding. And for me, in my job, I can see exactly who looks at my profile, and then I know my clients. And you can draw a lot of conclusions from that. So please don't go anonymous, Jason. Most transactions that happen are talent acquisitions. So we've decided that in Facebook, there is something we're not doing well. We don't trust our own team to sort this out. Is there somebody out there who's starting to crack that? That's by far the most common type of transaction. And I think the time where you as an entrepreneur can be that transaction is not just before you've broken through commercially, but it's also before you've taken on too much capital. Because buyers are very sensitive to the ecosystem. Most buyers do not want to buy companies if they know that the institutional investors will make a loss when they acquire. So in fact, they decline. So what you got to do is when you start thinking about your B or C round, is that's the time to really kind of in the founder group, look yourself in the mirror and say, are we going to crack it big time? Or have actually 2 or 3 other companies just surpassed us already, and we're a good business, but we're not going to be the category leader in our space. And then proactively consider whether maybe the best thing we can do is to take our great technology that got maybe overrun and put it in the hands of somebody that has a much more dominant distribution platform than we do. But do that then before you take that 20 million euro or 15 million euro round that gets so publicly announced, because your VC investor does that round are very keen that it's visible so that they can raise the next LP-based fund. And what happens is the buyer community suddenly believes, well, your business cannot be bought for less than $100 million. And suddenly you're back in that trap that only 18% of businesses gets bought over $100 million. Then we have bolt-on technology, and I see so much promise there in Eastern Europe and in Russia, with just fantastic engineering teams building awesome products, but maybe don't sit in the right place or struggle to find the right talent for global distribution. Then bolt-on technology is not a bad strategy. And now and then, buyers buy out of fear. They buy out of fear that their own business will be disrupted by somebody else. And here comes the key takeaway from my speech to you today, which is the only CEOs that have the ability to see disruption coming their way are disruptors. Hired CEOs are blind, and we have a lot of stats to prove this. So if you are the disruptor, your likely buyer is not going to be IBM or Microsoft. It is going to be somebody else who is a disruptor and have it in his blood and actually doesn't feel that it was very expensive to pay what, for instance, Mark paid for Instagram, which at least in my opinion, in hindsight, was a genius move by him and would have been incredibly expensive if he didn't do it. But if you remember, it seemed nobody else on the planet thought that at that point in time. So, how are we doing on time, Farley? Okay.
Questions or?
Okay, I'll keep on going. So
Yeah.
I'm going to shift tack a little bit to not just bore you about M&A, but what we do every year is within the group, we think about stuff that gets us excited. I mean, at the end of the day, if you don't get excited, don't go to work. I mean, it's a great job to run a beach bar or do surf lessons in Australia. I mean, clearly more fun in other ways, unless you geek out totally and get excited about this. And we get really excited about collaborative consumption. I mean, this is obviously a big trend in the US, but I'm a bit appalled by how little of it I've seen in the startup ranks in Europe. I mean, so please bring that on. The disruption of education, it's just the beginning. And I would say I'm incredibly impressed by Khan Academy. And any of you have children or have an interest in relearning yourself, you got to go there. It absolutely takes the best of internet, of gaming, of video, of interactivity, and teaches you something really useful. Still, I don't think that is the best example. I mean, the best example is when you can get into the heads of young people and they believe they're having fun, but they're learning something very valuable. I mean, a good example of that for America would, of course, be Call of Duty that we build in Sweden, because they learn how to kill people. And, you know, Farley, no offense, but a few of them really like that. So that's a good system. But a better system for Europe that gets me more excited is Minecraft. I mean, this is an incredible platform for learning architecture, the basic sense of math, of 3D space. And anybody who has done any level of coding know that just the understanding of 3D is one of the most fundamental parts of your brain that needs to come together to deliver the kind of products that we like. So we have this backward discussion in our household, and my wife sits over there. Cecilia, raise your hand. Because we have a 10-year-old son who really likes to play Minecraft with his friends. And I think this is fantastic. And he has a mother who really thinks he should do his homework. And so the mother comes into the room and he's like, Axel, you got to stop this. You can't sit in your room. I mean, this is the third hour with Skype on and Minecraft and all your friends. And on your mobile, you're doing Clash of Clans at the same time. And then I come in and say, don't stop him. He's multitasking, he's engaging with people, he's building. There's no chance they can teach him that nearly as well in school. So I would say, skip school, play Minecraft. How many in this room skipped school when they went to school? Okay, so 20%. I promise you that statistically you will be more successful than the rest of this other group here. The rise of curated and personalized content, yeah, this is easy to say, but it's very hard to do, because curated content means it's a human being, not an algorithm that picks something for you. It comes with two disadvantages. Geeks like us like to solve stuff in code, not with people. So it goes against the grain of our whole industry. So maybe we need to hire people out of the hotel or travel industry into our companies to understand curation properly. The second thing is it's really expensive because it requires human beings again. And you may not be the online business you thought you were in the form of a margin perspective. But it's absolutely certain in my mind and that AI can only take us so far. And you know, the recommendation of a movie or a book or a pair of trousers or choosing this hotel, you can't just solve that with AI. We need to bring people into the industry. We need to become the great employer of the next century. And something that gets me excited here in Europe, which is not talked about enough, and there are so many more companies than these, many in Finland, for instance, that are really doing cool stuff with UI. And I mean, the man-machine interface is the beginning and the end of the journey. I mean, until we can drill it into the skull, which I actually would be willing to experiment on, we need this stuff, and it is very, very cool. And there's so much to come here. What's tough, though, is that the cycle is much longer than we're used to. So it requires patient investors, it requires patient entrepreneurs. I worked 7 years ago with a company in Denmark where Bob Goodman from Bessemer invested, and in fact it was his first ever European board seat, and a man with a track record of, I think now is 105 NASDAQ or New York Stock Exchange IPOs in tech, you kind of have to respect. And we were sitting in this meeting and they were doing a very, very low power, low frequency solution to wirelessly connect light bulbs and blinds and all this normal stuff you have in your home. And we had this key meeting with GE. And we got it. GE signed a global deal to roll out this tech. And we're like, we won. And actually, the tech started selling this year, 7 years later. And when we talked to GE about that, they're like, yeah, we're on such an accelerated path here. I mean, this is just crazy. I mean, we're going to have this tech in the market in 7 years. Can you believe it? And we were all sitting there like, yeah, and in the meantime, somebody will build Facebook, Twitter. So it's a different game, and I think the smart investor will balance its portfolio, but also balance his mindset. And the smart entrepreneur has to kind of choose here. I mean, do you have that in you? Do you feel good about that? Consolidation, I'm going to skip that. Video calling goes corporate, sure, but how exciting is that? And actually, trend 7 is clear. I'm absolutely sure it's going to be true that the new Xbox is going to kill the PS4, but it's a big who cares, because the console gaming industry is a valuable industry, but I think what we can do with all the other devices now is a lot more exciting and a lot more money-making. And it just feels to me, and I wish I had the larger wallet, that the slam dunk deal here would be to buy Nintendo, throw out all the Japanese and start distributing it through the Rovio ecosystem on iPhones. Gamification, I think we see that everywhere. This is one of these great innovations that creep up on us. I mean, why is, for instance, Twitter and LinkedIn so exciting? Well, it's kind of, you're being scored. I mean, every time you get that little email, bling, you know, you have a new follower, you see his little profile, he seems to be a very cool dude. You're like, a cool dude wants to follow me, and it's schoolyard psychology, big time. And I'm just very disappointed because I mostly get guys to follow me, and I wish I was gay. Wearable tech, and notice now the absence of 3D printers. I want you to really go away here. They did not put that as a trend. Remember, we did not put that as a trend. That's really cute, but it's a very expensive way of producing stuff, and Taiwan and China know how to do it in volume very cheaply. Wearable tech, however, is cool. This is definitely coming. I mean, you can say it's there because you clearly wear the iPhone, or mostly today, 83% of the time, it's an Android phone from Samsung. But we're going to see a lot of devices that come together with that. They're definitely not going to look like this Samsung watch. Is there anybody in here want to buy that Samsung watch? 0. Okay. How many in here believe that whatever is the Apple Watch sleeve thingy is going to be successful? Hold up a hand. It's about a third of the room. If we define success as being much, much less in revenues than iPhone, but similar to iPad, how many still hold up their hand? Okay? See, I have no idea. It'll be interesting to see. Just to kind of round this off, I mean, our market is huge. It's huge in so many ways, and you see all these numbers all the time. But let me actually, instead of just browse them out, let's talk about them. $36 trillion of market cap in companies that in some way are touching the innovation we're in. What this means in reality is that in every boardroom, there is a technology and internet discussion going on, even if it's in the forestry or ball bearings business. I had a meeting last week with Connie and Thomas, the founders of EQT, which is the most successful private equity buyout fund in the Nordics. They mostly own non-tech, and they were calling on me to find them internet tech entrepreneurs to sit in the boards of every non-technology company they own. I mean, it's important to recognize that that's the case now, whereas in 2003, you went to a cocktail party or some friend's dinner party, and you're like, hello, I'm Per, I work with technology. Be like, and you know, they went to some buyout. 1.2 billion access the web. They're mostly Asians. Go build a business in Asia. Internet is huge. Global mobile subscribers is absolutely enormously huge. And in fact, I think we will have so many SIMs per person that it just pales. And probably the trade here is to go along the operators, because while they will keep on wasting their money trying to be anything but a pipe owner, the pipe they own is actually really valuable. Mobile advertising is kind of obvious. Now, the last piece. Remember I said earlier that only the disruptor will understand the disruptor. And in fact, only the disruptor can also create value. And this is, of course, you should all start hedge funds now when you've seen this. So this is Microsoft under the leadership of Bill Gates, is blue. He created $520 billion of equity value to himself and others. And then Steve Ballmer has wasted 230, I mean, that's kind of a record. I mean, how many people destroy $230 billion of capital? And I mean, if it wasn't for the treasury always printing new money, I mean, who knows what that would have done to the world economy. It's not always the founder that's the disruptor, but here comes a man that goes into a mainframe business and he says, actually guys, this thing called software and services is much cooler than you think. And can you imagine coming into a company where you have kind of, even the guys who do analog engineering think the guys who do digital chipsets are kind of not true engineers, and telling them that services where you sit opposite human beings is like a cool business to be in. Well, he succeeded inexplicably with that and built $150 billion of value that then actually have been pretty well taken care of, but at a much slower rate. Intel under Andy Grove, I mean, an absolute amazing case, $140 billion of value as this whole industry were created. But also, during this phase, this company didn't have an easy run. I mean, severe competitive pressure, particularly from their own value chain, who wanted to make them less valuable by playing out against others. And of course, the favorite for everybody, Apple. And the reality is he also created a bit of value here, but it kind of the scale destroys that because he created 300 billion of value afterwards. And then some people just don't seem to be able to die. And, you know, they just go on and on and on and on. I'm sure he has a metallic heart. And actually, I think when he bought Sun Microsystems, so I think we all kind of know he did to get around antitrust for MySQL, and I think kind of Morten Mikos, I wish was here, is kind of a bit of a pussy for selling MySQL so early. But it was probably so that he could put a Spark station in his head, and that seems to be working really well. So, and then imagine how much more value this would have been if he didn't take so much out of the company every year. And now, then you got to look at the younger teams that have 20 years to go, and I would say, if I were an entrepreneur, not in the financial services field, but in technology, I would do everything I can to not compete with this company or that company. I mean, that just feels so unnecessary, because we look at only 60 billion and only 300 billion, and I think when the young bankers in the firm stand here in 10 years' time and do this, those are going to be the biggest numbers, much more than the earlier ones. I think what Mark Benioff has done is great. I mean, he's had more M&A approaches in his life than you know, prostitutes see men. And he just keeps on going in a pretty non-exciting part of technology, building, average software, fantastic selling, and just the right model at the right time. And I think we'll see more of that. But to round this off then, my final slide of today is you can just see the power of these super entrepreneurs. And I think they're very good to bet on and bet with. I think it's a great strategy to try to disrupt companies when the super entrepreneur has left the building. That's the time to step up and disrupt them. And I think until that time, I think it's likely you're going to be in for a tough journey. So I don't know. Any questions? Back over there.
You mentioned that the investors are frustrated because they can't invest in successful game companies because game companies produce a lot of cash. But as a long-time game developer and stuff, it's very difficult to get investors to invest in you until you don't need it. Do you recommend that we just blow off talking to investors and do it ourselves? Or do you recommend spending some time looking for investors when there's good opportunities and having a team?
Well, it's a great question. And I think the challenge for investors, not to disparage them, is that gaming is so hit-driven that it is very hard to build a case around making an investment in a game before it is successful. And as you say, once it is successful, the need for external capital in most cases go dramatically down, wherefore that window for an investor to come in and for an entrepreneur to want to take the capital can be only a couple of months. I think to answer the question is I do think you should keep on talking to the investors, not get frustrated by the fact that they're not pulling the trigger. And even more so, I think, with the investors that you like, let's say that it's a handful, be very transparent with your KPIs. I mean, I would send them my numbers every week in just a spreadsheet. You never have to tell them about how cool the game is, because they're not going to take a view. But they will take a view at your adoption rate. They will take a view at your App Store ranking and so forth. And they will take risk, but they have to see a trend and hear much less about the concept. So that's what I would do. And then I think the other thing I would do is I would talk to successful game companies. I mean, the people who can also take a qualitative view are people who have built games. And I mean, we have some really successful game companies today with people that have quite big wallets.
One more question.
Per, I'm Stefan from Doughty Hansen.
Hi, Stefan.
Per, great talk, very entertaining and interesting. You made an interesting point about technologies such as UI stuff, which takes a long time to be adopted, which creates problems for the entrepreneurs. Because when I started doing venture capital 10, 11 years ago, VCs would do big, hairy hardware type of deals that would have a lot of upfront R&D, and with a view to be eventually monetized, which didn't work out well for most VCs. And the end result being that today VCs pretty much only look at very capital efficient stuff. On top of that, you have the issue that VCs are constantly being accused by LPs, their investors, for not showing liquidity. At a recent private equity event, one guy stood up and said, "There's no such thing as a 10-year fund. They all last, on average, 14 years." So I don't think VCs get a lot of applause for taking these long-term bets, which creates an issue for these, entrepreneurs in terms of where should they look to for capital. I mean, certainly the VCs don't seem to be the right place.
No, and it is true. And as long as the VC community has to operate under the demands of the LPs to be defined life, it is a tough call. I think there are some ways for the entrepreneurs to act here. One is, I think many entrepreneurs overlook going to the semi community and actually have them spend money on your behalf, spinning your chip. Mm-hmm. I mean, TI, for instance, is very proactive right now, building chips for startups. So that can take out $5, $10, $15 million of money you need to raise out of the equation, as long as they get some form of co-selling right. But even that can be negotiated. I would say the corporate venturing arms like Intel Cap, like Qualcomm Ventures, and there are many others, and increasingly also the Asian corporate venturing arms, Samsung Ventures, super active here in Europe right now. They can take a much longer view and are probably better allies there.
That's a follow-up question.
And then I think the final piece that we've seen, for instance, in Flatfrog that's in this space, we brought in a US fund called Invus, and they're an evergreen fund. And I mean, there are evergreen funds, and the good thing with evergreen funds is they can take 20-year bets. But I think you're right.
Yeah. A follow-up question on that. There's actually a segment of growth companies, companies that maybe do 10, 50 million euros in turnover that are maybe borderline profitable, but they're not growing at the rate that a Summit or a TA or somebody of that caliber would get interested. So perfectly viable business, maybe not quite venture material. Who's going into that segment? I mean, who's hunting for these type of deals?
We're starting to see US growth equity funds come over with more of an kind of operative attitude. So they say to us that, we're looking for companies that grow 10 to 20% a year with a profitable track record, but they're happy with very marginal profitability if they can see that it's been used for expansion or product development. But it is a gap. To us, it looks like there is alpha there. It's a good place to be an investor because most VCs don't get excited enough about it, and they're not profitable enough to really start to go into the tech private equity community. But we see some US capital. We don't see any European fund really that go after this that I know of.
Interesting. Thank you.
Thank you, Per. Great start.